All right, so here is 10-1 notes, organizing a corporation. It is not a really large chapter. We only have two sections to this. Some of this is going to be review from Accounting 1, just a matter if you did it last year when we were doing the COVID stuff or not. I might have been even before that, but um, we'll get started. I'm not going to read every single thing for you. We just want to talk about what a corporation is. Obviously, most companies start with a proprietorship, but a corporation gives them another level of finance that they might not have or already had with a partnership or a sole proprietorship. Um, Organization with legal rights for a person with many people or persons inside the corporation is called corporation. Corporation is organized by law. Exists so that it's separate from its owners. Ownership is divided into what they call shares of stock. A unit of ownership in the company is called a share of stock. All these people that own units of stock are called stockholders. Um, Total shares of this ownership is often known as capital stock. These stockholders are called shareholders as well. Okay. Most of the time, these corporations, you invest money, capital into their corporation, and you're allowed to get dividends or earnings or percentages of their earnings as they expand and as they increase and as they continue to do well. You hopefully will continue to earn earnings on your investment. This is the little articles of a corporation. Just has name, what the business is, how many stock options, what they invested, an address, what the terms might be, if there's some directors or not, who's involved, and it is signed. And you don't need to, you're not going to fill this out. Just kind of gives you a little bit of an idea of what a basic, very, 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 very basic garden variety articles corporation is. Before anybody gets any dividends of any kind, the board of directors is a group of people that is elected by stockholders to make decisions based on the best interests of the corporation. The board will be the one that will decide dividends and when they're going to be paid out and how much is going to be paid out. And it could be based on their terms of the corporation. It could be based on their what they think is best for the company at that time too. All right, legal requirements. This article that we talked about is just a legal document identifying the characteristics, the name, the terms, the stock that's out there, board of directors, all those things. That needs to be submitted to the state. You'll have to pay a fee of some sort in order to get this articles corporation verified and okayed by the state. Mostly are done by state. Some could be done federally, but most are done statewide. The state approves the formation by issuing a charter, which means the legal right for this company to conduct business. So that's just kind of some background, getting to understand how to set up what a stock, a corporation, how a corporation set up, and what our transactions are going to be is based on these stock transactions, the ownership being transferred back and forth. This is a stock certificate. It used to be something that was a little more involved. Now it's more electronic. But for our purposes, for just understanding the basics and accounting of corporate stocks and issuing of stocks, there's going to be two different types: common stock and preferred stock. Common stock's the most common. It is a stock that doesn't give the stockholders any special rights. If you have common stock, excuse me, you are allowed to get dividends. You can vote in shareholders meetings. Often you'll give your voting proxy to someone else. Like I don't vote on anything of any of my stocks, or bonds and and funds. I don't vote on that. You give your proxy to others. But you get a share in the earnings. You do have the right to vote if you can or if you get involved. And the distribution of assets, you can sell these assets, make money if you prefer. These are all advantages of being a common stockholder. A preferred stockholder is someone that gets preferred shareholder preference over common stockholders to a certain degree. Preferred stockholders will not be able to vote, but they might get there. If there's a limited amount of earnings, they will get theirs first, and we'll get into that later. And really, it's not the end of the world if we don't need to be specifically, we're going to be told if it's common stock or preferred, and we will often deal with common stock. They just are telling us there's two different types. The stock certificate, the picture that's above, is written evidence that these you are the owner of these whatever specific number of shares of stock, the number that you bought, the name, date, all that good stuff. With the chances of stock keep changing, and then transfer of ownership, buying and selling a stock comes so common that it's usually just electronically done on a computer, so we don't mail stock like we used to certificates. Okay, changing ownership of stock is referred to as stock transfer. All right, we got value stock here. There's going to be some par value stock. There's going to be non-par value stock, and there's going to be stated value stock. And we'll do a problem for each one of these. And they're very, very, very similar. It's like we're splitting hairs a little bit. Value of stock to share of stock printed on a stock certificate is going to be called the par value. Par value really doesn't mean that's the absolute cost or market value. It's just a stated generic number sometimes. And we'll get into that a little bit later. But if they say par value, it's a value that is assigned to the stock. A share of stock that has par value is called par value stock. Share of stock that has no authorized value printed on the stock is called no par value stock. All right, some states require that no value stock actually are assigned a number, but there is such a thing. No par value stock can be assigned a value by the corporation. So they might just say, if you're going to buy the stock, one share is going to be $25,000. They don't really say its par value is 25 or whatever the case may be. Okay, so they'll send a arbitrated value to the stock, and it'll be based on the market. People will either invest or they won't. So we have par value stock, non-par value stock, and then stated value stock. All right, and we'll get to that a little bit later. Again, we talked about common stock earlier. If the corporation only issues one kind of stock, it'll be common stock. They're entitled to dividends. They have the right to vote. The board of directors appoints an independent auditor to decide who does these kind of things. If they authorized a $1 par value common stock, you'd be able to buy a share for $1. Preferred stock is a little bit different. It means they don't have voting rights, like we mentioned before. They can't influence how much is paid in dividends, but they are typically receive dividends prior to common stock. And so there's a few advantages. Basically, you're just getting their money, and they don't get any say, but they get paid first in a very, very, very generic way. Unpaid dividends may accumulate and be paid in a later quarter. Any accumulated preferred dividends must be paid to preferred stockholders before common stockholders. Dividends shared with common stockholders above a stated value percentage or amount. Once the dividend to common stockholders equals that stated percentage, additional dividends may be shared between preferred and common. Basically, short end, to keep it super simple, common stock, they get a vote. They get their shares of dividends. For preferred stock, they don't get a vote, and they get their dividends first. In a very, very basic kind of way for what we're needing to do. Often preferred stock will be stated in a percentage, like 6% of $100 par value stock, or they'll get $6, 6% of the $100 dividend. So if they get a dividend, they'll get 6%, or $6 per, how many shares in this example. Capital accounts for a corporation. We're not going to list again everybody that buys stock. That would be impossible. So we're putting corporations only common stock. If that's the one we're doing, we'll put it under common stock or capital stock account. That'll be our single capital stock account. If we're looking, we do common and preferred. You get into that later on in college and stuff, but we won't mess with that right now. Corporation's net income is recorded into what's called retained earnings. If you have net income, it'll be credited into retained earnings, and a net loss will be debited into retained earnings. We'll talk about that later as we continue on. Advantage and disadvantage of a corporation. We also talked about sole proprietorship. You guys are familiar with that. Business owned by one person, partnership, two or more people combined. There's limited liability partnerships. There's limited liability corporations. There's a variety of different ways of having a business. Advantages and disadvantages for having a corporation are there's a lot, and we're not going to read through all these, but the main idea is you are separate from your investment. They can't, if you invest in a company and it goes under, you only lose your investment. You don't lose your house, your car. It's not your liability. If somebody gets hurt at the work and it's a corporation, it's going to sue the corporation. It's not going to sue you personally, although you will lose your investment, if something were to happen and it went under. But it gives you some liability coverage. Advantages, it's easy to formate. You got to file out papers but they don't make it excessively difficult. There's that limited liability. You get some money. There's terms that are involved. You write that charter. You write the terms. You try to figure out, how this corporation is going to be run. Usually when they say it's perpetual term existence, it'll continue on no matter who the owners are. Just kind of the way, different variety of things. You can transfer ownership of these corporations. So these are some advantages. Disadvantages. There's some regulation involved in corporations, what you can and can't do. You don't get to just make all decisions. You have to share these with others. You have to obviously share the profits with the people that are investing in your corporation, the shareholders, stockholders, dividends. But then there's also taxation that goes along with it. Earnings could be subject to state and federal taxes, and then they are distributed to stockholders, individuals who then will have to pay taxes on the top of their dividends. So taxation of earnings to the corporation and to the stockholders who receive the dividends is called double tax. The corporation gets taxed on the dividends, and then when they pay them to the people, they get taxed on the dividends. Often, and people will form LLCs, a limited liability corporation, that if you have a smaller company, and these smaller companies could be $1 million companies, but they could be smaller, LLCs don't have to pay taxes on their earnings. Then their earnings go to their people that invested in the company, and then they go to their personal tax returns. And then those people have to pay taxes on what they earned. So you lose this double taxation when you're in these LLCs. And so a lot of LLCs, LLPs, as limited liability partnerships, have a variety of advantages. One of them being gets rid of that double taxation. Okay, so we're getting to our transactions here real quick. Received cash from Dale Pearson, 20,000 shares, dollar par value, common stock valued at $5 per share, 100,000. Okay, so what we're just going to do is we're going to figure out, we have a cash debit, which means they gave us $100,000 here. Okay, so we debit the cash. We have capital stock common and paid in capital in excess of par value common. Okay, this paid in excess of par value common is a new account. It is an equity account, so it's just like the revenue is increased with a credit. And so when we are issuing these, receiving cash for par value stock, someone's buying the stock from us, we will increase this excess of par value. So they say it's $5 shares of stock for $20,000, or par value is $1, excuse me. Par value is $1. They bought 20,000 shares. So the capital stock common is 20, but they gave us 100. They paid in capital in excess of par value 80,000, and so we have to put that in that account. Okay. It says value at $5 per share. That's why we get the 100,000. So they had 20,000 shares that originally was at $1 par value. They're buying these shares for $5 a share. So 20,000 times 5 is 100. It was originally for $1. So we put the original capital stock common for the amount of par value They paid in excess of par value. The 100,000. The difference is what was the paid in excess. And they talk about it all in here, and they show you the T accounts. Common stock with no par value received cash from Elizabeth Griffin for $1,000 or for 1,000 shares of non or no par value common stock, $5 per share, 5,000. So when we receive cash for no par value common stock at the listed amount, 5,000 for this $5 per share, it's just capital common stock credit, and then you debit cash. Okay, the entire amount paid by investors recorded in the capital stock when you're dealing with a no par value common stock. Up here, we're dealing with par value of $1. They valued it at 5 and gave us 100, so that's why we had this paid in excess. This one, no par value, whatever they buy, is we're throwing in common stock credit and we're cashing the check. Common stock with the stated value is a little different. The excess per share is still recorded paid in capital excess of stated value, whereas prior to that, it was in excess of par value common. So it's just a little bit different. So what are we talking about? Corporations may assign value to common stock. The value is known as the stated value. Stated value serves as the same function as par value. No par value stock with stated value is recorded the same as par value. So basically what we're saying is, receive cash from Alice Blake for 50 shares of $10 stated value common stock at $200 per share, $10,000. So you bought 50 shares of $10 stock, $500. They paid $10,000. So they're saying that the value they paid was $200. So that paid in, $200 paid in excess of the stated value common is the difference between what they paid, what the par value was, and what this is. That's all she wrote. Okay. So you have $10,000 cash. You had the $10 times 50 shares, and it's a stated value. The difference is paid in excess of stated value common. And that's kind of it. This talks about making sense of dollar cost averaging. This kind of just, if you put $100 in the stock market and invested $100, and this is a common thing if you haven't taken econ, or if you will, they always do. They might use phrases like widgets. This isn't uncommon. So if you paid $100 and each widget cost $100 or $1 or stock, but if you invested $100 and we bought $1 stock cost, we'd have 100 shares or 100 widgets. Well, the next month we buy 100, but now the widgets only cost 75. So we invest $100 at 75. Now we were able to buy more widgets, 133. The next month it drops even further, 65. We're able to buy 153 with our $100, and then September the cost goes up to $1.25, so we can only pay 80. Okay, so you can kind of see you've ended up buying 466 widgets in these 4 months, but now the cost of them is $1.25. You bought them at $1.75, 65. Now they're at $1.25, and you have 466 widgets that are worth now, if you wanted to sell them, $125. So they show you that your $400 investment's now worth $582.50. It's kind of an idea what investment and buying the capital and investing into companies. Just a little tidbit. So that is 10-1. I hope that made a little bit of sense. Again, we're scratching the surface of all this, and we'll continue learning on it.